Hi, everybody. This is Chris for Invest LYH, and today I wanted to discuss something that came about in a recent interview that I did with Mike Zuber from One Rental at a Time. So I'm going to go ahead and share my screen. Give me just a second here, because when we were talking, something that Mike brought up, Mike has an econ background as I do, and he talked about a possible soft landing when it comes in terms of rates, and I mentioned that within the aggregate demand model that we use to measure growth in the United States, it is possible. So I didn't have enough time really there to go into it. Plus, I want to show you guys what it looks like. So I pulled this from an open exchange textbook. Let me get this guy here. Um, and this is the same theory that I would get from my McGraw-Hill textbook that cost $130 for my students to go into. But the basic principle is when we talk about growth, we call it GDP, right? Growth or gross domestic product. And what we see is that it is equal to what we call aggregate expenditures. And the aggregate expenditures means how much different sectors of the economy are spending. And we can see up here that it has a few different variables: consumer spending, investment spending, government spending, and spending on exports minus imports. So what we do in econ classes is we say that the aggregate expenditure equals C, consumer spending, plus I, investment spending, plus G, government spending, plus exports minus imports, right? So you would say X minus N M, sorry. Um, so the reason why I said M is because sometimes we call it NX in other classes. But so when we look at this though, and we were talking with Mike, and he said, well, um, could the Fed do a soft landing by raising rates a little bit? And I said, well, given that consumption and investment will decrease, if the government increases a little bit, it will help smooth that out as opposed to having a downturn. Now, theoretically, this is what I'm going to show you how it looks like. If we agree on this model right here, okay, then what happens is whatever occurs on this side of the equal sign will occur on this side of the equal sign. So if we think that consumption is decreasing, then aggregate expenditures will decrease. And same thing with investments. And what I said on Mike's show is I said, well, will the government be able to increase to offset these two? So rather than have a decrease in aggregate expenditure, we're just going to have a level, right? And I think he said 0.2% of GDP growth. And if we agree up here, GDP equals aggregate expenditure, what we see here is if we increase the government expenditures at an equal or greater rate, it should keep us within that 0.2 GDP increase. It doesn't always happen in theory, in practice. In theory, this is exactly what the economists at the Fed are looking at. They're looking at these macro expenditures and they're saying, how can we be able to encourage certain aspects of the economy? Because the bulk, as much as people think the government is the reason why the bulk of the inflation occurred, that's true, but it's not. It's not because of government spending. It's actually because of what we call a multiplier on consumption and investments. But generally, that comes down from the Fed increasing the money supply. Let's do this. Increasing money supply, or M1, right? And what happens is then this cash is funneled through these areas over here. which then goes out, multiplies, and then what happens is uh, we have more cash and the same goods, services. Okay, that's kind of how the inflation occurs. So if we know this, where is the Fed going to want to combat the inflation? Right here and right here. So they're assisting interest rates to rise so that let's just redraw it right over here, C plus I plus G plus NX, right? So now these guys are not gonna consume as much because we have higher interest rates, which means higher cost of money. Investments are gonna be less. But can the government come in and increase their spending, which we talked about a little bit where the jobs report's coming out? There's a lot of government jobs out there that are being reported as new jobs. And so when we look at the jobs from these sectors, consumption and investment, they're decreasing where this one is increasing. And what that tells me is that they're trying to make sure that instead of having a downturn in overall GDP, they're trying to say we just need to flatline it. So that instead of we have the recession like this, maybe it can be like this and then pop back up. So this is just kind of an overview. If you guys have questions about the different models that they use, this is the model that they use. So I know some people out there they don't like this guy, Keynes. He's what they use. So we have to kind of learn what they're doing in order to understand where these opportunities exist. But I just wanted to go over that with you guys. I'm going to put a link to the open textbook in the video, and I'm also going to link the video that I did with Mike. And I mean, it was an honor to be on that page. He has helped me a lot, and it's interesting when you talk to somebody with another economic perspective on the housing market in general, and then we can kind of talk back and forth about how this will play out. So thanks, guys. I'm going to go ahead and get ready to turn this off here. Bye, guys. Thanks.